Hey everyone, welcome. We're going to talk today a little bit about some simulations and simulating the stock market. There's a pretty cool algorithm called the Gillespie algorithm. It's particularly useful in simulating stochastic processes in molecular biology. I wanted to try out a variant of it here. Now we're going to simulate the stock market and help really explain the price of Tesla. So, let's begin. Okay. So, the main takeaway from this video, I think, is this Gillespie algorithm. So, I just want to dive right into it. I'm working in Python. Just as a brief intro, I pulled some data for Tesla stock prices over about 1,000 days, and looking at this chart of the price of Tesla over time, this observation that this simulation is going to be based around is that you can sort of picture these price fluctuations as periods of high growth and periods of high loss. So we're sort of walking along and then boom, there's an event. It's a good event. Maybe Tesla announced the robotaxi and stock price went way up. And then maybe the next day, Elon Musk got in a fight with the president and there's another event and the stock price tanks. And that's sort of the idea that this simulation that I'm implementing in this algorithm. And let's see how to do it. So we're back here to the code. And what we need to start things off is we need to figure out where the Tesla start price and how long we're going to do the simulation for. So we take those in. And then, like we just talked about, we're sort of going to be tracking if there's an event going on, causing high increase in price or high decrease in price. So we'll keep track of that too. Okay, so we start out our simulation and we start keeping track of the day it is. Once we hit our maximum number of days, we break out of the simulation. And sort of the first thing, we'll skip over the top for a second. The first thing that we want to ask is, we're just in here in the simulation wandering around. When is something going to happen? So that's what this tau is. And you'll notice that there's this random number and then there's also this weighted probability. And the weighted probability is the interesting part. It sort of breaks down all the different things that can happen and gives them the probability that is associated with them. So up above, when I pulled in that data set for Tesla and I plotted it, I also grabbed some stats of that data. And one of the stats that I grabbed was the rate at which an event ends. So if we go back up to it, we'll see that there are sometimes these super sharp and super sharp up and super sharp down, and they don't last forever. So we sort of want to know how long one of these events is going to happen. And that's this first rate, the rate at which an event ends. Now, there's also sometimes these sideways moves that maybe not too much is going on, and we want to keep track of those too. And that is, in these nothing periods, how long is it going to take for a new event going to happen? How long is it going to take for a new news announcement or one of these events? So I calculated that above too. So this chunk of code right here sort of just sticks these numbers in, and it says, while we're walking along, is there an event happening? If there is, well then the probability of the event ending is that value that I calculated above, and the probability that a new event is starting right now, well, that's 0 because there's already an event happening. Okay. Now the alternative is if there's not an event happening, then obviously we can't end an event if there's no event going on. And also we want to know how likely it is for a new event to start. So that's what that is. Okay, so we've got those probabilities, those weighted probabilities sorted out. We use those to figure out when the next thing is going to happen. And now we identify what is going to happen. So just as a breakdown, we know that two things can happen. Either there's going to be an event starting or an event ending. So if the event is happening, then the next thing that's going to happen is the event's going to end. And when the event ends, we have to calculate the change in price of the stock over that time period. Otherwise, there's no event going on, and this next time period is the event starting, and the price of Tesla stock increases or decreases. It sort of just hovers along sideways. So that's what this else statement is. Let's just go a little bit into detail about how this price change is calculated. So if the event is going to end, then the event has been going on this whole time, from right now until until this event is going to end. The price is going to be increasing or decreasing at a fast rate. So that fast rate is sort of captured in this thresh value. And that I set earlier when I was sort of doing this data analysis and figuring out what exactly it means for an event to be an event. Well, I said that is if the average price increase over a few days is at least 3% per day. So this is something that I set, but it sort of means that it's going to be a price increase that is noticeable. It won't just be hovering around flat. This interest rate is just random noise. So if everything is totally random, this is just a little tiny bit of price movement every day, with standard deviation 1%, mean of 0. So sometimes it's going to be positive, sometimes it's going to be negative, but it's sort of just going to be normal sideways movement. This thresh value is going to be usually way more dominant because it means that there's an event going on. Okay, there's one last caveat that I have here in this calculation, and it is that the interest rate can be up and it can also be down. So that sort of determines whether the event is a price increase or a price decrease. I did no data analysis on whether it's more likely for Tesla to have up events or down events. I just said that that's 50-50. It's a normal distribution. And whatever we get here, we're going to follow through with the direction that the price is going. So if the interest rate is negative, then the price increase is also going to be negative. Because this number will be less than 1. And then every day that goes by, we're going to decrease by that interest rate. Okay, so that's the algorithm. And now let's see how it works. So we just went over this simulation code, and now we're just going to do the simulation. All right, so here we got a lot of bad events in a row in the stock price tank, except obviously this is only one sample trajectory and many things could happen. So let's try it again, 10 times this time. Okay, so we got 10 graphs and we got some huge spiking, some big plummeting. All in all, again, it's sort of hard to figure out what might be expected for this sort of simulation. So a lot of things could happen. So let's try to run it again. This is a graph of all of those charts on top of each other just so that they're easier to compare. Let's Let's try 100 of them. Yeah, so here we get some bulk behavior, sort of staying level, and then a few outliers up, maybe a few guys who went really low. Here we go. This is the same chart except with 500 simulations, and yeah, maybe this is a reasonable way to gauge the bulk behavior. The median at the end of the 100 days is 426, and the average value is 531. So this sort of makes sense. Like with the graph that we looked at, the general trend of Tesla was going up, so could keep going up if the future sort of matches the data. So yeah, we've got some pretty reasonable information on Tesla. Am I gonna bet the house on these results? Me personally, probably not. But yeah, it's definitely an interesting experiment to run. And yeah, I guess we'll just test one more time. I'm curious to see if we up the number of simulation days to maybe 300 to see what happens. Let's plot. Yeah, so according to this simulation, if you run it 500 times, then the average value Tesla stock is 718, and the median value is 392, which is really interesting because it sort of says that even though right now it's 435, maybe the bottom half, like you have an over 50% chance of going down in price on Tesla. However, the expectation is going up in price because the winners, there are less than 50% of these trajectories that increase in price, but those that do increase in price by so much that you expect to make money on Tesla in the long run. That's sort of interesting. Yeah. Is this advice? It's just an interesting model, and it sort of captures like this philosophy of Tesla to be a big risk taker. But yeah. Thanks for watching, everybody. It was a fun video to make, and hopefully you learned something, and I'll be back next time. Okay.